Hello, I'm Tian Wei, and welcome to World Insight. The Federal Reserve raised its key interest rates by a substantial 3/4 of a point for third straight times to tame inflation. It also signaled larger rate hikes to come. The Fed's move boosted its benchmark short-term rate, which affects many consumer and business loans, to a range of 3% to 3.25%, the highest level since 2008 financial crisis. Since March this year, in response to the general spike in oil prices, food prices, and other living costs, the Federal Reserve has raised interest rates for 4 times, with a cumulative increase of about 225 points, but this hasn't arrested inflation in the U.S. So what will be the impacts of the Fed's latest move on the U.S. economy and those of others around the world, where the U.S. dollar is still the dominant reserve currency? My conversation with 2 economists from China and the U.S. Glad to be joined by Michael Powers, Zurich Insurance Group Chair Professor from Tsinghua University, and also Professor Qu Qiang from Renmin University. Good to see both of you. The Fed action did not surprise a lot of people, and yet the impact has very much been the focus of debate. What do you see, Professor Powers, of the latest decision?
I think that the biggest impact is that people are now getting used to the idea that the U.S. Federal Reserve Bank is taking inflation seriously, and that there will be further increases in inflation in the interest rates to come, and that there's a possibility that may cause the U.S. economy to go into a recession. How big the cooling period, how long and how deep it will be, remains to be seen. But I think there is now more awareness that this is something that is likely to happen.
What about for you, Professor Qu?
Well, I think nobody can assume what's going to happen in the next 12 months, because you're looking at we already have 3 to 3.25% of the interest rate in the USA. That is very, very high in the past 10 years. And also, according to Mr. Powell's a comment, probably we're going to look at the 4 or 4.5% of the interest rate in next year. That's probably 90% for sure. And with the interest rate that high, you probably just going to think, if I am a foreigner, I switch my currency into US dollar and I put them into US banking system, and immediately I'm going to have 4.5% of the interest rate income. That is phenomenally high. And also considering US dollar is appreciating against my currency. For example, against the Japanese yen is like 20%, Korean won is more than 15%. So you're looking at 20% of the income immediately safe. So with that kind of income, who would do real business? They probably switch all your currency and save them into the American banking system. Yeah. So that's going to be devastating for the foreign countries and also for US economy player as well. So we're going to looking at many, many non-performing assets and the debt real economy probably in the next year.
3 times in a row, unprecedented this rate since 1980s. What does that say about the U.S. economy? Let's have both of you to talk about that first.
The most important thing that it tells us is that the Federal Reserve Bank is playing catch up. It was slow to start to address the problem of inflation. And only starting in the second quarter of this year, 2022, it's already made these 3 significant increases. There will be further increases. It tells us that this is a serious problem.
But will that really going to address the inflation problem? Will different income groups in the U.S. feel very differently about the impacts of this policy?
I think that it will address the inflation problem. Professor Qu has noted that it will have some dramatic impacts domestically, not just internationally, in terms of lending, people being able to borrow money. Whether this will have the same impact at different levels of wealth, I'm fairly sure that it won't. But I think that overall it will lower inflation.
There are a number of numbers that people are looking at. Those numbers, according to the latest prediction, are not likely to perform as well as earlier thought. For example, the labor market number, the employment rate, and also the GDP number. How do you see this latest policy by the Fed vis-a-vis other trends in the U.S. economy?
First of all, well, with 3 times rate interest rate hike in the past 1 year, first of all, I'm going to say yes, it's going to help with inflation because people's expenses is going to be hugely raised. For example, if you have $1 million condo in California and you borrow the mortgage and every month previously you're going to pay $4,000 a month. But with the current interest rate, you're going to looking at 6,000 or even 7,000 monthly mortgage. So which means you're going to spend less on your food and on your clothes. And so they will reduce your demand and then the price is going to fall. But that's just for one thing. But for the other thing, maybe the answer is no. If you look at the past, the Federal Reserve believe in MMT. For this theory tells the Federal Reserve that printing money will not cause inflation problem, but more of the deflation problem. But now Mr. Powell has decided, okay, more money is going to be the problem for the inflation. So I've decided to do the interest rate hike so we can control the inflation. But everybody understands interest rate hike probably will not fully solve the problem because the supply chain, the raw material, the energy prices, and that price up is not caused by the monetary supply. So how the situation is going to be, we're not very sure.
Well, with regard to GDP growth, I think that probably the Fed's forecasts, which are very small, like 0.5%, going up to something over 1% for next year, I think that those are probably fairly reasonable. I think that this is the path that Chairman Powell is following. He wants to cool down the economy, and that may take us into a recession, a true unemployment recession. And when there is a rise in the unemployment rate, currently unemployment is at a relatively low rate. If we go above 4%, perhaps it's like 5% or more, that certainly will have an effect on consumer demand, and that will lower prices.
Is China's monetary and fiscal policy likely to deal with the latest impact?
Of course, we're going to be worried about that because in the past 20 or even 40 years history, it showed that every time when America tightened up its monetary policy and the US dollar flow back to US, and which caused the shortage of the monetary supply all over the world. And China is going to be suffering from that as well. It's just a question of how much extent. But China will have more of the foreign reserves, more than before. And also China has more of the fiscal power as its hand. So China is going to worry a little bit less than the other countries. And also for China right now, China still have its sovereign and its own independent monetary policy. We're still lowering the interest rate for the domestic economic recovery for sure. But also, I don't think Chinese central bank is going to just shoot out its foreign reserve like it's the running water. So at some point, for example, when Chinese yuan is depreciating to like say 7.2 against US dollar, so we're going to use some other tools at our hands. For example, the reserve ratio for the reform reserve, the counter-cyclical factors. These are very effective as proved, but also in the future, China still needs to raise up an interest rate, probably the end of this year or early next year. So we can just shorten the spread of the interest. So the capital outflow can be just soothed.
Professor Powers, there's a lot of issues of shaping and being reshaped by the others.
I think that in terms of the impact of the Fed's action internationally, it will vary from country to country. I think that China is maybe at one extreme in that it will be more insulated from the negative impacts than other countries will be. I think that the U.S. already has, to some extent, exported its inflation to other places. We see it in Europe, the UK. They are probably going to take a similar action, or already have, in raising interest rates. The European Central Bank earlier this month took an action raising interest rates. India and Brazil, it's a somewhat different situation. They tend to have higher rates of inflation overall. So the most recent impact is less. They may not have to take as dramatic an action. But this idea that Professor Chu indicated that, in a sense, the U.S. Central Bank, the Federal Reserve Bank, coerces the reserve banks around the world to follow its monetary dictates.
Now, do you see the world less vulnerable, same, or even more now than 25 years ago and 15 years ago?
Okay, I would say that compared to either 15 years ago or 25 years ago, the world economy is in some sense more vulnerable because in recent years, especially since the 2007-2008 crisis, we've gotten used to loose money. And this is the way that the U.S. Federal Reserve Bank and other central banks address this problem. Is that they reduced interest rates and they made money supply plentiful. People got used to it. They borrowed money for projects that might not have such good rates of return. And now we're going to have to draw some of this back. It's going to be painful. There will be companies that go out of business. There will be competition for that funding internationally. Developing nations will be hurt. Especially?
Well, for me, I'm saying the whole world, yes, is much more vulnerable, as Professor Powers has said, for sure. Because if you're looking at the monetary issuance of the current world, you're looking at, exponentially increased more than in the year of 2008 and more than in 1997. So we're looking at a bigger flood coming at us. But also, there's a learning curve, as I mentioned. China and ASEAN countries, many ASEAN countries used to be victims in the previous two financial crises. And we've been learned our lesson. So if you're looking at the ASEAN countries' currencies and also Chinese currencies and the capital market, you find out they have better regulations of the capital account, and they have more of the buffers, like the foreign reserves. So if you like the ringgit of the Malaysia, if you look at the Singaporean dollar, Chinese yuan, they're much more stabilized than the previous two times. But also there's a learning curve, as I mentioned, newly emerged countries like the Sri Lanka, like India, like many other countries, they're still learning their experience, but I believe they can do better.
It's a fascinating topic, even though it is also a worrisome topic. Thank you so much for both of your insights. I'm sure we're going to be in touch on this and more for months to come. Thank you. Michael Powers, Chu Chiang, appreciate it. Bye.